I have to say our liquidity is almost unique in the marketplace now, and it's firm. So we have more liquidity this year than we had this time last year, and of course the year before that. I'm also seeing increased liquidity outside of major pairs. So yesterday we had our biggest day ever in dollar CAD. Seeing a lot of growth in some of the emerging market currencies. Some good days in dollar Sing, dollar China. So I think a lot of that is probably as is this race away from last look liquidity. Perhaps people anticipating regulatory changes, regulatory moves, and you've had all the bad news stories in the press and all the banks being fined. So I'm seeing a lot of banks coming back to us, pricing more aggressively, having worked on their models, and I think being profitable in what can be quite a challenging environment. You know, making firm prices in an anonymous pool is quite difficult. But I'm seeing a lot of them come back having altered and tweaked their models over the last 2 or 3 years. So I think firm liquidity is probably better than ever in the street. I think what you're seeing is a lot of the last look liquidity becoming as phantom as it ever was. There's the primaries that were firm liquidity that seem to be moving more to disclosed. They've all been set up 20, 25 years ago. Show me another one that's set up with firm liquidity in the last 5 years. Predominantly firm liquidity. Potentially the number 3 or 4 in the market has 20, 30% firm liquidity. So I would argue that we print more on a daily basis. So I think, look, we could argue till the cows come home. I do feel we offer something unique. Going back to Liam's point earlier, I empathise with the banks and liquidity providers and that. And incidentally, although I'm probably campaigning for the abolition of last look, I don't think it has to be abolished on a bilateral basis. I think if a customer is made aware and a bank streams a price to the customer, then why not? It's just another rule of execution in that bilateral relationship. But in my view, it should be abolished and it shouldn't be allowed on anonymous open order books. And I believe that's how the bulk of FX will be traded going forward. I don't necessarily go along with the argument that it's going to be the case for long term, because the banks own customers, the banks own flow. And if I'm honest with you, over numbers, they're the ones that are most there in terms of providing liquidity. I think they always will be. They have some regulatory challenges, they've got some internal challenges around risk, whether they can run risk, what's the information between sales desks and trading desks. And I think they're investing in technology. So I expect them to come back. I expect them to be important.
But until they do?
Look, people tell me that HFTs are taking over liquidity. Most good bank market makers have a lot of low latency technology in there. So they're also in the same bucket. What people really don't want is this latency ARB style of HFT. So yeah, I think, look, in the next year or two, you might see some of the big names, they're on a lot of your panels, from non-banks, will come to the forefront as leading liquidity providers. I don't necessarily think that's going to be the case in 2020. You might even see banks gobble up some of the better non-banks as liquidity providers. And you know what, I think these things go in cycles, because banks look at return on capital. At the moment, they're saying, yes, let's all go agency. It's very hard to produce 25% return on capital through just running an agency desk. So I think risk will come back in some way, but probably not 2016, 2017.